Hello, my name is Manny Kagan. Together with my wife in 1985, we started Pacific Bay Financial Corporation, which is oldest mortgage brokerage in the Bay Area at least. And I recently also started Money Solutions Academy. And my special guest is today Jeff. I rather prefer call him Jeff, but he also has last name. It's Simonich.
Correct.
Oh, you see, this time I did it right? He works for a company with very unusual name. It's called Change Wholesale. It's something different. And yes, a company has something different. When he told me about this program, when we had conversation on the phone, I said, wow, my viewers have to know about this. And it's called CDFI. Government like to this acronyms, right? Which stands as Community Development Financial Institution.
That's
Correct?
correct.
Wow. Now it's your turn. So tell us about what it is and how this can benefit our listeners and the client.
Okay, great. So Change Wholesale is a division of Change Lending, and we are a community development financial institution. There's several thousand CDFIs throughout the United States. We've very quickly become the largest CDFI, and we're one of the only CDFIs that have leveraged the certification, which is awarded by the U.S. Department of Treasury, leveraged it into a full-blown mortgage banking platform.
Interesting. We used to have those loans where special loans for special people, whatever special is, but this exists now. It's wow. So tell us what it is.
Okay, so again, a CDFI is a certification awarded by the U.S. Department of Treasury, and its purpose is to serve what have been traditionally considered as underbanked or underprivileged borrowers. That includes borrowers of certain ethnicities and/or properties that are located in low to moderate income census tracts. And so our mission as a company is to provide a mortgage platform, including products that serves these communities and these types of borrowers who otherwise may have been shut out of the market from traditional financing.
Give us very specific example. What kind of borrowers and what kind of locations?
So what's unique to a CDFI institution is we have an exemption to the RESPA laws that calls for ability to repay.
Okay, RESPA. We see RESPA is Residential
Real Estate Settlement and Procedures Act.
Yeah, which is an organization which prohibits us professionals to doing certain things. For example, we cannot give kickbacks. This is one of the RESPA violations.
Right.
We cannot pay anyone money to get business.
Right. But also out of the financial crisis, RESPA was amended through the Dodd-Frank regulations. And part of that was in response to the global financial crisis and some of the poorly designed loan products that were available up until 2008, 2009, when almost brought the financial markets down. And then the regulations kind of came in and tried to prevent some of the things that were being done that were not prudent lending at the time. So one of the big things that was a part of that, a huge component of that, was what we called stated income loans, where anybody could put any income on an application and it wasn't verified. And there were low credit scores being done, very low down payment loans. So this time it's different because our CDFI certification gives us an exemption to the ability to repay guidelines. So some of the loans
ability to repay, it's a very interesting concept, because what lenders check when they underwrite loan, they check certain parameters, what I call 4 C's or 5 C's, is because you have to have income, you need to have equity, you need to have ability to repay, and you have to have certain credit. And what you're telling me, this CDFI doesn't require that?
Well, we're still pursuing prime borrowers who have good credit, good reserves, good character, have shown that they pay their bills over time. And we do require a certain equity position or down payment in these programs. So they're not low down or low equity loans. They're basically made to prime borrowers who have challenges in the either employment or income category.
But you also said ethnicity.
Yes.
Okay, give us specific example.
So specifically Hispanic and African American borrowers, as well as properties that are located in low income census tracts. We do provide some special incentives. It's not required that you are a part of one of those categories in order to qualify. However, if you are in one of these categories, which are identified by the Department of Treasury as systemically underbanked populations, we will provide a $1,795 underwriting fee credit.
I see. Now it translates into money.
Yes.
With the rest forbids us to pay others, but government gives certain people certain money.
Yeah.
It's okay.
Now,
yeah.
to distinguish though, you do not need to be one of these categories in order to qualify for our programs. You just are able to take advantage of certain incentives that come along with that.
So that is interesting, because when clients fill loan applications, one of the questions government requires, you have to indicate your ethnicity. And no one will go into check. You can write anything. For example, African American often do not mark it because they're afraid that they're going to be discriminated. So what you're saying here, somebody else, to enable you to get the 1750, you can mark anything. You can mark Hispanic or African American, whatever they call it, and get the money.
Yeah, because there can be some subjectivity to ethnicity. We have chosen to go off of the section of the application where the HMDA data is collected in order to determine their ethnicity. So we will use the borrower's representation of their ethnicity to determine that.
So you don't have HMDA. In other words, HMDA is this part which requires those disclosures.
Right.
So what, you have different loan application?
Nope, same loan application. They are just asked what their ethnicity is on the application. So,
and the people, but if somebody says, I decline to comment, then he's not getting the money?
That's correct.
Oh, so you know what, you instruct, in other words, I love the way where government is working. Now, first you tell them, if you are Hispanic or African American, you might be able to get some money from this, some benefit.
Yeah, that's kind of a sidelight of our program. I think more importantly, we need to look at the program, which is called the community mortgage in its totality. And again, you don't need to be of these categories in order to qualify for the loan. It's just an added perk if you happen to fit that box. So we're primarily going to be underwriting these programs on, number one, FICO score, which is a credit score. And then that's going to drive the down payment level and the reserve requirement, the amount of money that people need to show that they have seasoned in the bank for 30 days, in addition to their down payment after closing costs.
And now what you're saying, there is very specific requirements. Because when most of my clients, rarely have clients who have scores less than 700, and you can go as low as what?
We can go as low as a 640 credit score,
which is reasonable, because some program even tell me 550.
Right, but if you have a 740 score or higher, and again, we're really seeking prime borrowers who have just had employment or debt to income calculation challenges with other lenders.
Okay, so let's focus on advantage, because so far it's very general description. What's advantage? Somebody who comes in and says that I am in this category, and then you have census tract. This is another one, which is census tract is something which is easy to check. If you live or buying a property in specific area, geographic area, which belongs to the census tract government set up, right? It used to be in Pacific Heights was census was part of this, but it was a mistake. So then you have some other benefits.
Yeah, I mean, the first thing you're really going to do as a loan originator is what you normally go through to qualify a borrower. So you're going to be checking their credit, you're going to be checking their employment, their income, their assets, and determining what kind of program they fit into. So in this economy, especially now in the advent of COVID, we have a lot of borrowers who are self-employed, who are gig workers, real estate agents, retired folks who don't work, tech workers who maybe have a big portion of their income into stock options, all these things that can kind of create a challenge in the prime underwriting world as it relates to employment or income. We're not requiring that borrowers state their employment or their income on the application.
Wow.
So this is different than the subprime
crisis days. Now we're talking.
So this is different than the subprime crisis days where there was incomes that were inflated that were put on applications. So there's no representation being made with respect to income and employment. And our exemption as a CDFI allows us to bypass those two categories for good credit borrowers with good equity positions or good down payments and good reserve positions.
Basically, those four criteria which you just mentioned, four, maybe three, whatever. So you need to have what? You need to have, you don't care about income. No income mentioned, okay? But you do care about money, which has to be seasoned only for 1 month.
Correct.
Wow.
And another important distinction, we're referring to owner occupied and second homes,
Okay.
1 to 4 units.
Okay. So client comes in and says that I want to buy the property. And I say, wonderful. I don't care about where you work and what you do.
Correct.
Do you have money for down payment? Yes, my brother is giving me, cousin, whatever. Can you allow the gift?
We will allow 100% gift
100% gift. So money can come from any source as long as it's seasoned for 1 month.
in a U.S. based banking
Yeah, okay.
institution.
Money goes to the US bank institution. And then if you just happen to speak Spanish, then you're probably benefiting from the 1750.
Not a lot of people speak Spanish that are not of Hispanic ethnicity.
All right, so you have to have ethnicity. Okay,
Yeah.
So, and then if property is located in specific census tract, what does it benefit from that?
That's $17.95 underwriting fee.
So
credit.
now it's you need to have both ethnicity and
No, one or the other.
one or
and
another.
just one borrower on each transaction. Yeah.
Okay. So no income qualifying. Yes, you have to have good credit.
Yes.
At minimum 640.
Correct.
What other criteria? How do you underwrite a loan?
We're underwriting on FICO score, down payment, and or if it's a refi, the equity position in the property, and then reserves. So the borrower needs to demonstrate that they have anywhere between 12 and 24 months of money seasoned in the bank for 30 days after close on a purchase or in the bank on a refinance transaction.
I think you have to pinch me because it sounds so realistic.
Well, you know,
okay. So how? Give me an idea. What's loan to values?
Loan to value, we can go up to 80% to a $3 million max loan amount with a 740 credit score. And then as your credit score goes down, your down payment requirement will go up. So if you go all the way down to the 640 minimum, it's going to be a 35% down payment requirement. So
and give me, okay, I have to shake my head. So tell me, and what are the interest rates on those loans?
The interest rates are going to be in the mid 8s to high 9s.
I see.
Which is tracking anywhere between 1.5% to 2.25% above prime rates.
Okay, so the point is like this. Yes, higher, but then I have to be sure that client will be able to make payments because this is my responsibility. If I put someone in a loan, I want to be sure. So for me, it doesn't matter what you do. I will check their income qualifications.
Right. Well, it's been determined that these particular loans, the CDFI community mortgage loans, as compared to the mainstream non-qualified mortgage market, are performing as good or better because we have borrowers with strong credit character, money in the bank, and good equity positions. And those people have shown they've paid their bills over time, and they've got equity in the property or a big down payment going into the property. So you don't have a propensity for them to walk away. You know, if they did run into trouble, theoretically, they could sell their house because they have a strong equity position. So it's not a high likelihood of default or performance problem on these loans.
Jeff, you just gave me another tool in my ammunition. It's very unusual, and thank you for coming and thank you for sharing. My name is Manny Kagan. I promise to help you. Thank you.
Thanks.